Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us discuss now the concept of trading on equity. When company decides to raise funds, it has got two options. It can raise own funds and it can raise borrowed funds. It can issue shares, equity shares, preference shares when it has to raise its own funds, that is owner's fund. But when company takes loan from a bank or it issues debentures or it issues bonds, in that case company is relying on borrowed fund. Depending upon the requirement of company either selects own fund or borrowed funds. Company has to select a proper ratio of own funds and borrowed funds. When company in a position to borrow funds at a particular rate, say for example 10%, and with that amount company say can earn 15%, then out of that 15%, 10% will be paid to borrowed funds and the balance 5% will be added to shareholders' earnings. If this is the situation, it is called as trading on equity. Companies can take benefit of this. They will borrow amount from outside business. They will make huge returns. They will make huge earnings and then they will make payment to borrowed fund so that equity shareholders can add their earnings. Equity shareholder can enhance their earnings. This is not possible every time. If companies overall earnings are less, then after making payment to borrowed funds, the very small amount may remain for the equity shareholders, or there is possibility that shareholders may not get any amount. So selection of best capital structure is necessary to enhance, to maximize owners' returns. If company goes for borrowed funds, it pays interest, and interest is an expense. As it is an expense, it will reduce the profit. That means payment of interest helps company to reduce its tax liability. By considering this angle, if borrowed funds are taken, company can minimize tax liability and thereby more profits to the shareholders. We'll discuss this concept with the help of one problem. You are called upon to make a comparative assessment of the following three situations. Situation number 1, 10% debt 2 lakhs, equity 8 lakhs, total funds invested 10 lakhs. Situation number 2, 10% debt 5 lakhs, equity 5 lakhs, total funds invested 10 lakhs. Situation number 3, 10% debt 8 lakhs, equity 2 lakhs, total funds invested 10 lakhs. Assuming that the rate of interest required to be paid on debt is 10%, it means here on all loans we are paying 10%. Calculate the maximum rate of dividend payable to equity shareholders when the rate of earning is 8% under all situations, 24% under all situations. Here we are required to ignore the amount of taxation. According to first situation, that is 8%, we are required to take the rate of earnings. that is 8%. Here total funds invested are 10 lakhs. So we'll have to take earnings as 8% of 10 lakhs. Rate of earning 8% on 10 lakhs. So earnings will be 8% of 10 lakhs under all three situations. So earnings before payment of interest is in this case 80,000 for situation 1, situation 2, situation 3. We have to consider now interest on 10% debt. In situation 1, debt is 2 lakhs. So interest will be 20,000. In situation 2, 5 lakhs means interest will be 50,000. In situation 3, debt is 8 lakhs. So it will be 80,000. In situation 1, earnings are 80,000, interest 20,000, so profit available to equity shareholders 60,000. Maximum rate of dividend, that is profit divided by equity multiplied by 100. 60,000 divided by 8 lakhs share capital multiplied by 100. So in situation 1, it is 7.5%. This is returned to shareholders 7.5%. In situation 2, total earnings are 80,000 minus interest 50,000, profit available for equity shareholders 30,000, maximum rate of dividend 30,000 divided by 5 lakhs multiplied by 100, that is 6%. In third situation, earnings are 80,000 and interest is also 80,000, so there will not be any amount available for equity shareholders. So we cannot calculate dividend ratio here in third situation because equity shareholders won't be getting any amount. As per second assumption given in the question, 24% earnings under all situations we are required to consider. That is 24% of total funds, that is 10 lakhs. Rate of earnings 24% on 10 lakhs. Earning 24% of 10 lakhs comes to 2,40,000. Less interest on debt at the rate of 10%. It will be same amount 20,000, 50,000 and 80,000. Profit available to equity shareholders 2,40,000 minus 20,000, 2,20,000, 2,40,000 minus 50,000, 1,90,000, 2,40,000 minus 80,000, 1,60,000. Now let us calculate rate of dividend, maximum rate of dividend, profit divided by equity capital multiplied by 100. In first situation, earnings 2,40,000 less interest on debt 20,000, profit available to equity shareholders 2,20,000. Rate of dividend profit divided by equity multiplied by 100. So 2,20,000 divided by 8 lakhs multiplied by 100, 27.5%. In situation 2, total earnings 2,40,000 minus interest 50,000. So profit available to equity shareholders 1,90,000. 1,90,000 divided by equity capital 5 lakh multiplied by 100, it comes to 38%. In situation 3, total earnings 2,40,000 less interest 80,000, profit available to equity shareholders 1,60,000. Rate of dividend 1,60,000 divided by 2 lakh multiplied by 100, that comes to 80%. So we have calculated returns to equity shareholders, that is maximum rate of dividend if earnings are 8%, if earnings are 24%. Under all three situations we got a rate of dividend. Like in situation 1, rate of dividend if earnings are 8%, it is 7.5%. If earnings are 24%, it will go up to 27.5%. In situation 2, if rate of earnings are 8%, there will be 6% dividend to equity shareholders, whereas if it is 24%, it will be 38%. In situation 3, if earnings are 8%, no dividends will be paid to shareholders, but if earnings are 24%, they are going to get 80% dividend. By analyzing all these three situations, we can draw some conclusions. For analysis of three situations, we are required to focus on amount of borrowed capital in all three situations. In situation 1, borrowed capital is 2 lakhs, that is 10% debt, amount is 2 lakhs. In situation 2 it is 5 lakh, and in situation 3 it is 8 lakhs. As we move from situation 1 to 2, 2 to 3, borrowed funds have increased. If earnings are 8%, that is earnings are very less, we find that in first situation only there is payment of 7.5% to equity shareholders, then it has got reduced to 6%, and finally in third situation it is nil. That shows that if rate of earnings are less, depending more on borrowed funds will be risky for the company. It's a financial risk, because we are paying 10% interest on loan and we are earning only 8%. So that is going to put shareholders to suffer a loss. When earnings are 24% and we are paying only interest of 10%, it will be more beneficial for a company which is high geared. In this case, that third situation where there is more loan, we can see that 80% is amount available to equity shareholders. In first situation 27.5, in second situation 38%. So when rate of earning is 8%, equity shareholder suffers, as trading on equity works in reverse direction. In all situations, rate of earning is 8%, that is lower than interest rate 10%, thereby equity shareholders returns becomes very low. In situation 3, it is nil. Under this situation, if company is highly geared, there will be loss for equity shareholder. Like in situation 1, they are getting only 7.5%, that is less than the interest rate of 10%. In situation 3, due to high geared, no returns to equity shareholders. Thus, there is financial risk if earnings are less and borrowings are high. If rate of earnings are 24%, here equity shareholder benefited. They get good returns due to trading on equity. When rate of earning is 24%, that is higher than the rate of interest 10%, equity shareholder gain in all three situations. Gain is more in situation 3 as it is high geared situation. There is scope for speculation of company shares in that particular situation. Thus, we can conclude that when companies' earnings are less, it is better, it should more depend on own funds than on borrowed funds. If earnings are more, then it can take risk and it can depend more on borrowed funds. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.